Okay, I think we will begin. I'm asking everyone who is not the speaker to turn off your volume and also your video. And we're going to go straight through them, 13 to 15 minutes each. I'm going to ask the audience to submit your questions through the chat. I will be watching the questions. I will accumulate some questions, and at the end of the presentations, I will read out the questions I've accumulated, and then each panel will have a chance to answer the questions. And if we have time, we'll go through a second round. So we're going to begin with the first presentation on Europe. So go ahead. I'm not sure which one is speaking.
Hi, I'm Izaura, and this is a co-authored paper with Mariana Mortàgua, who will speak in just a few moments, on the European Single Resolution Mechanism and how it uses market instruments and logics to achieve its intended policy goal, which in this case, it is to resolve ailing banks. There is a general consensus around the European regulatory architecture in the sense that it is complete and it will guarantee the intended goals of financial stability, European integration, and an equality of treatment between member states. Within this general opinion, the problem of the banking union pertains to the lack of rule enforcement. And there's precisely a call for a necessary harmonization of national liquidity frameworks to avoid member state bypasses to liquidations or extensive bail-ins. Critical literature points to concerns of the bail-ins as rule in the liquidationist genie, the asymmetric effects mostly stemming from its asymmetric inception and different national preferences, and the still missing fiscal access that is associated to a common deposit guarantee scheme, celebrating this year a decade of SOL implementation. We argue that there are two overlooked outcomes of the banking union resolution framework, namely that it has asymmetric effects across countries given their distinct banking structures and sizes, with preferential outcomes to market-based financial systems within the union, and the concentration of banking capital in fewer and larger financial institutions, promoting an overall marketization of business models. Based on these two overlooked outcomes, we further argue that the European financial integration project is being done at the expense of regulatory-driven consolidation that represents another step towards the neoliberal configuration of Europe and reinstates market discipline within this market-based finance logics. The latter is set to reinforce the control finance has over political outcomes, as highlighted in the literature of governing through financial markets. Governing through financial markets describes a mode of governance where policymakers resort to market instruments to achieve economic and policy goals, linking the success of those market practices to their own governability and steering capacity of the economy and financial institutions. It is a process that embeds market logics in the regulatory framework, such as the definition of safe collaterals, and outsources political governance to third-party market agents, therefore creating an alignment between public interests with those of the financial sector, and therefore boosting the latter's influence over the political, policy, and public spheres. While this strategy of governing through financial markets is not novel or new, or unique to Europe, an increasing strand of literature is framing different aspects of the European polity as governing through financial markets, that is, increasing the prevalence of market-based finance, a case in point being the latest large-scale reform of the European Capital Markets Union. The banking union has remained outside of this criticism, mostly as it is considered a post-crisis necessity. And our goal here is to analyze that the banking union single resolution mechanism as a market-based policy framework and outsourcing of government's powers to the market that not only reinforces the marketization of economic governments and the European integration agenda, but it further consolidates financial interests.
Okay, I guess this is me now.
Yes, this is you now.
Okay. So as you probably know, the banking union consists of a single rule book that ensures the harmonization of banking regulation and centralization of the supervision and resolution powers through the creation of 3 technocratic independent bodies, such as the single supervisory mechanism, the single resolution mechanism, which we'll be analyzing today, and the European Deposit Insurance Scheme that, as Izaura told you before, there is still no agreement in order to put that scheme in place. So there are 3 main steps in the resolution framework. First of all, there is a pre-assessment of resolvability that ensures that a bank can be liquidated, or as an exception, it can be resolved. The main aspect of this process is that it involves the establishment of minimum requirements for own funds and eligible liabilities. This is called the MREL. These amounts are determined by the Single Resolution Board, not for prudential purposes as normal capital requirements, but only for resolution purposes. The second step is the failing or likely to fail declaration. A bank will be liquidated or resolved if it is declared to be failing or likely to fail by the ECB based on a somehow discretionary assessment of whether that bank's charter is at risk, whether that bank has entered or is likely to enter in a balance sheet or liquidity insolvency, or in the case of any public support given to a bank if that bank is considered not to be solvent. So public support immediately triggers a declaration of failing or likely to fail, and then a bank will be resolved or liquidated. After being declared failing or likely to fail, that bank will be liquidated unless the Single Resolution Board declares that it should be resolved in the name of public interest, whatever public interest means for the Single Resolution Board. Once a bank is resolved, the first step is a mandatory bail-in. So the bail-in will include all capital and liability instruments, including deposits. National deposit guarantee schemes will pay for insured deposits in the resolution, even if the resolution is decided by institutions at the European level. After the bail-in, there are only 3 possible options within the European framework. There is the sale of business, the sale of a part of business, so the sale of quality assets of the bank being resolved, or the creation of a temporary bridge bank that must be sold within 2 years. Therefore, the result of a resolution will always be the sale of banks, and the rules allow this process not to be a market sale, as the competition rules would require, but to be shaped to facilitate the transfer of the resolved assets to pre-selected larger competitors at the European level. In terms of financing arrangements of the resolution, there are very complex rules. They are summarized in the next slide, which I will not present, but there are 2 aspects that deserve attention. First is that the use of public funds is always forbidden within the European framework, and it's only allowed in the case of a systemic crisis and after all other possibilities have been exploited. So the primary source of funds in case of a resolution is the bail-in. Then there is the use of the resolution funds, which are still underfunded in Europe, or other private solutions such as loans from the banking sector. On top of this framework, we also have to consider that any public intervention, any kind, in the context of a resolution or a liquidation, will always have to be authorized by the European Commission under the state aid framework. You already know for sure that state aid rules in Europe forbids state injections in any national entities. In particular, in the banking sector, public injections, in order to be authorized, they imply the previous approval of a restructuring plan by the European Commission that requires downsizing, disinvestment, and firing workers, as the European Commission also assesses a bank's return to viability. The European Commission also requires bail-in measures similar to the ones in the resolution framework. And plus, the European Commission limits the financial support to an ailing bank to the very minimum necessary and only to avoid serious disturbances in the economy. So the European Commission has this criteria of what is the minimum support that must not meet the objectives of prudential or resolution authorities, such as the ECB or the Single Resolution Fund. So quickly, there are several underlooked issues with this framework, which we have summarized in two groups, and I'll try to explain these two groups. First, there is this limited toolkit of intervention that translates, in fact, in the prohibition of public intervention in the banking sector, and that promotes the fire sale of banks and therefore the concentration of banking capital in Europe. Second, the effects of this one-fits-all bail-in rule can have very different impacts in different countries and can create serious difficulties to small sovereigns, as we have seen in the financial crisis. Secondly, and paradoxically, the limited toolkit exists in Europe amidst a problem of discretionarity, in the sense that a bank's viability or a bank's public interest is evaluated according to a number of market-based criteria that depends on the assessment of these technocratic institutions, such as the ECB, the Single Resolution Fund, or the Commission. For example, a large number of current regulatory requirements are determined on the bank-by-bank basis, namely MREL. The minimum requirements for own funds and eligible liabilities is determined by the Single Resolution Board on a bank-by-bank basis. For example, a small bank that is funded traditionally by deposits and capital will have to issue expensive market-based instruments such as subordinated debt, which pushes that bank towards a riskier business model. So discretion in terms of regulatory requirements can push a bank into resolution, or it can change the way the banking system is structured in Europe. Another example of arbitrarity is the decision if a bank is failing or likely to fail, which depends solely on ECB's perspective on future potential compliance problems, or even on ECB's willingness to support liquidity, to supply liquidity to that bank. On the other hand, public interest assessment depends on different ideas of what public interest is and what financial stability means in the geographical context of the EU. As a quick example, 2 Portuguese banks have been subject to fire sales in 2015 because in 2016, the resolution decision would be transferred to central authorities that had already stated that they would liquidate those Portuguese banks. And one of those banks was the 3rd largest bank in the country. Finally, state aid compliance depends on the Competition Directorate of the European Commission, which is known for favoring market outcomes at the expense of small countries and the national interest of small countries. So apart from the rules and the limited toolkit that promotes the sale of banks, discretion is important because it allows these technocratic institutions at the European level to promote the goal of a market-based integration. This goal of financial integration that implies a structural change of European financial structure through cross-border mergers mostly, has been clearly stated by the high representatives of the ECB. They clearly want financial integration through mergers and a structural change in the European financial system. Izaura, can you?
So the main conclusions of our paper are that the transfer of state agency and discretionary powers to the Single Resolution Board, the European Central Bank, the DG Comp of the European Commission, as well as their Single Resolution Mechanism limited toolkit, are promoting the regulatory-driven consolidation of the banking system. by eliminating smaller to medium banks that have traditional business models and therefore cannot compete, transforming overall business models towards risk-driven profitability and market integration, and even ruling, as Mariana just said, the absorption of liquidated and resolved banks by larger European financial institutions. As such, we conclude that the single resolution mechanism should be understood in the context of an alliance between the Commission, financial interests, and technocracies that want to shape economic governments at the European level. What can be described as a financialization of economic governance in the case of this single resolution mechanism is this market-based statecraft that has this overreaching integration agenda and implies a puzzling return to known instability drivers in a post-crisis context, namely the prevalence of market-based finance, the promotion of too-big-to-fail institutions, and the fostering of regional asymmetries between member states and banking systems that were already pointed out as culprits of the European financial and sovereign debt crisis to begin with. Thank you.
Perfect. Clear, and you kept to the time. So now, Alex, let's see if we can shift the PowerPoint over to Alex. And I want to remind the audience, I am watching the chats for questions. So please type in questions and I will accumulate them. Let's see. Alex is getting his PowerPoint up.
Let's see. Let me see. Do you see my whole screen at the moment?
Yes, we do.
Yeah, okay, perfect. Okay, thank you. I will present our paper, The Evolution of Monetary Policy Focal Points. The problem is I need to shrink. I can't see the whole screen myself. Here we go. So this paper is also linked to central banks and power as the previous paper, but it has a very different perspective. Essentially, our question has been and sort of is still whether the central bank and the state can and should fix and steer the long-term interest rate. So it's really an old question that we want to answer using a new method. And we use an approach that is sort of we're talking about focal points here. And starting off with the classic question Thomas Schelling asked in 1960. So if you were to meet a stranger in New York City, but you couldn't communicate with that person, when and where would you meet? The most common answer is noon at Grand Central Terminal. This classic case has been used in game theory quite a lot. But if we sort of look at it from an institutional economics perspective, we can see that focal points typically have sociological, institutional, political underpinnings. And there's always some kind of habit or convention or quite often power that determines these focal points. When I talk about focal points here, I'm sort of putting a number of different words and sort of use them as synonyms, like anchors, targets, benchmarks, pegs, focal points, are all different ways for central banks to sort of coordinate actions by market participants or the wider public. Now, why do they use these? Well, the idea is really to steer expectations of market participants and then sort of hope that the public will behave in a certain way. Now, if we scroll back in history, there are a number of different focal points. We can sort of talk about the gold standard. We can skip forward to fixed exchange rate regimes, which is really about determining a focal point in terms of a currency or an exchange rate or a range of an exchange rate. And the idea here is for the central bank to stick to this focal point and commit to it. And of course, the public needs to have trust that they will commit to this indefinitely. We know from history that this doesn't really happen. Sooner or later, the peg will be broken. But there are some countries that have managed to keep pegs for a very long time, like Hong Kong is a good example of the Hong Kong dollar against the US dollar, but also the Danish krona against the euro, previously the Deutschmark. But the narrative is classic. So once the market participants or the public starts to doubt whether this focal point can be long-lasting, the central bank typically goes out and says something like, in this case, the Danish central bank back in 2015 says, we will do whatever it takes to defend the Danish krona, or we will go on forever to defend the peg. But as you know, fixed exchange rates are mostly a thing of the past in developed countries. In the 1990s, inflation targeting became much more popular and has since been sort of become the standard in developed countries, but also a number of emerging markets. So focal points here are much more indirect, because if we use price stability or inflation as some kind of target, obviously it's not, you cannot buy and sell inflation itself. So in this case, the focal point is really about the short-term interest rate that the central bank has power over, which should then filter through to the economy and to inflation via the so-called monetary transmission mechanism. Now, scroll forward a little bit more to sort of early 2000s. A couple of central banks started to do something called forward guidance. Norway was a pioneer, Japan, Sweden, and lately also the Federal Reserve. Here it was about openly or being transparent and openly disclosing the view of the central bank, saying that suppose that this happens with the economy, what will the interest rate be in the future, and sort of give different probabilities for this to happen. So that is really forward guidance. It's really about sprinkling the yield curve with a number of focal points so that market participants and then obviously the public will sort of do what the central bank wants them to do. And these different focal points along the yield curve typically follow some kind of pattern following conventional benchmark maturities, like 6 months forward, 1 year forward, 2 years forward, and so on. So moving on from forward guidance and the financial crisis, I will just use 1 minute to talk about the financial crisis. What happened then? We all know quantitative easing, a battery of new unconventional monetary policies. I would sort of single out one event that was crucial here. Was in July 2012 when Draghi made his speech about doing whatever it takes to protect the Eurozone. That didn't involve any change of the focal point, but it was more a warning to market participants not to bet against the ECB or not to bet against the Eurozone project as a whole. So it was sort of a warning that people should not anchor their expectations to a breakup, but it didn't sort of change the focal point as such. Now, since then, and we know that many countries have near zero policy rates, especially in developed countries, but also in many emerging markets that are getting closer to zero. And especially since COVID, long-term interest rates have also fallen a lot. But generally speaking, the idea has been that what can the central bank do now? Suppose there is a crisis, what do we have left to do as a policy measure? And so overall, the focus has shifted to long-term yields. And here, Bank of Japan, which has been a pioneering central bank for decades, they did something extraordinary in September 2016, and they explicitly targeted the 10-year bond yield at 0%. So this was very radical because it's sort of saying that we suddenly have a new yield curve focal point, a new yield curve anchor, and it's the 10-year yield should be 0 precisely or very close to 0. And this is completely radical because, as you know from central banking, central banks typically have only steered the short-term interest rate, the one-day interest rate or the 2-day interest rate or maybe the 1-week interest rate, but not the 10-year rate. A brief historical reflection. This has happened in the past, around in the US after the Second World War. It was a very brief time. So you could say that Japan wasn't first, but definitely first in the modern era. So the situation in financial markets and in central banking was very, very different in the 1950s than it is today. So we can say that Japan is definitely a pioneer in the modern era. And it echoes an old debate from the earlier mid-19th century. Keynes, Horthy, Hicks, etc., is really about can and should the state systematically intervene to determine the long-term interest rate. So up until now, or up until recently, for many decades, central bank has been extremely reluctant to do so because they say, well, this is up to market participants to decide what the long-term borrowing cost should be. So in this paper, we use econometrics. We test two hypotheses. And the first one is this. So suppose that a 10-year bond yield is chosen as a focal point. Well, in theory, then, we should see that the importance of the other benchmark maturities should shrink. So the 5-year should become less important. The 15-year should become less important because essentially we are picking 10-year and nothing else. So that is number one. And the second hypothesis is, suppose that we now have a focal point, which is a 10-year. This means that the influence of the short end of the yield curve, i.e. that is linked to the monetary transmission mechanism, should also diminish, because if market participants no longer only care about the short-term interest rate, but also the 10-year, that role should diminish. Now, how do we test this econometrically? We use a methodology where we combine a TVP bar model with a dynamic connectedness approach. Now, there's been many new recent papers about using this methodology. I'm not going to go into in the detail, but what we essentially do is we explore the transmission mechanism among these different Japanese government bond yields and how they have changed since 1999 up until this year. So this is just briefly what do the yields look like since 1999. You can see sort of roughly that yields have been low in Japan since the Japanese banking crisis in the 1990s. They have also sort of gradually gone closer to zero, but they have also they are very connected, as you can see. So if one changes, the others changes too. But we don't, from this graph, we can't see which one is the most important one of all of these benchmark maturities from 1 year to 30 year. So what we do here is we look at, first of all, we look at the dynamic total connectedness, which essentially is about saying, let's say we have a universe where we have all of these Japanese government bonds, and we look at how connected is this universe, so how connected are these nodes with each other. If the connectedness is 100%, which means that it's perfectly connected, or if it's 0%, they're completely independent of each other. We can sort of say that from our results that yes, this system is incredibly connected, and it tends to be more connected when there is a crisis, like the dot-com bubble, the Great Recession, the introduction of this new 10-year focal point, and also the start of the COVID pandemic in early 2020. But that's not the main story here. The main story is how do these different yields affect each other over time. So what we do here is look at the directional connectedness. So if you look at the graph to the left, you see that some are negative, or also they have a black segment below zero, and some of them have a black segment above zero. Below zero means that they are absorbing shocks or influence from other yields. And if it's positive, it means that they are transmitting shocks to other yields. And the main story here is number one is that the short end of the yield curve, like the 1 and 2 year, they have been consistent receivers of influence. So since 1999 or even before, we haven't checked the early 80s or 1990s, we can see that the 1 year is always a receiver of shocks from longer maturity. So this sort of completely goes against the monetary transmission mechanism, saying that the short end influences the long end. It's actually the long end that influences the short end. And the second thing is the shock that we saw in September 2016 when they introduced this radical new policy was actually very short-lived. Very quickly afterwards, the attention shifted to long-term maturities like 15-year, 20-year, and 30-year. So only one slide left. What does this mean, or how can we interpret these results? Well, the first thing is that the results contradict the logic of the monetary transmission mechanism. The long-term rate can actually influence the short-term rate, and that is exactly what has happened here in Japan during the last 20 years. And the second thing is the establishment of a new focal point, like the 10-year interest rate, is actually much more feasible and less dramatic than observers might think. And actually, something that you should note here as well is in March 2020, immediately after the COVID outbreak, Australia introduced yield curve control as well for the 3-year segment. Now they wanted to, I think they wanted to get away from this in November 2021, but it seems to have been less successful than anticipated. So they're sort of still stuck with the 3-year target. And that's it. Thank you for listening.
Okay. And thanks for keeping the time. Let's transition the screen to Tanweer.
Okay. Let me share my screen. Let me know if you can see my screen. Can you see my screen? Share. Not. I'm trying.
Yeah. Not sure if I'm able to. If not, I will just speak. Well, just saying. So Renee, should he be able to share it?
Yes, he should be able to.
Sorry, it seems that I'm not able to do so, but I'm going to just speak in that case.
Okay.
Right. My paper is titled Keynesian Models of the Long-Term Interest Rate. It's motivated by the fact that there are several highly used benchmark models of the long-term interest rate in quantitative finance. However, the quantitative finance literature is yet to incorporate Keynes's insight about long-term interest rate dynamics. I believe that a Keynesian approach to interest rate dynamics can be quite useful in addressing both theoretical and policy issues. Moreover, I think that the Keynesian approach, or at least some aspects of Keynes's thinking, can be easily incorporated in the standard benchmark models of long-term interest rates. So what I do, in fact, is to modify these benchmark interest rate models to take a Keynesian perspective on modeling the long-term interest rate. Moreover, the empirical literature does support a Keynesian view, but of course there are debates, and among the post-Keynesian or Keynesians, there's debate within Keynesians as well, but at least it can incorporate some views. So the questions that I ask are, what are the factors that drive long-term interest rates? Does specifically short-term interest rates influence long-term interest rates and modify the benchmark models? And address what else matters, what are the issues in debate. Just to contrast with the Keynesian view, the conventional view is based on the mainstream view is the neoclassical view, which is based on the view that the long-term interest rates depend on the demand and supply of funds in capital market. And also, specifically, this has been emphasized by many, that an increase in government debt and deficit ratios lead to higher long-term interest rates or government bond deals. And there's a range of literature that influences this. Keynes, however, takes his view from was motivated by Reifler's empirical studies, who wrote, and I quote, "The surprising fact is not that long-term bond yields are relatively stable in comparison to short-term interest rates, but they have reflected fluctuations in short-term interest rates so strikingly and to such a considerable extent." Keynes, in the treatise, noted that, quote, "The efficacy of the bank rate for the management of a managed money was a great discovery. Its application in varying conditions were not clearly understood and have not been clearly understood." That from the volume 1. And then he goes on to say a number of things about the determinants of long-term interest rate. And let me quote selectively from Keynes. Quote, "The influence of the short-term rate of interest on the long-term rate is much greater than anyone would have expected," unquote. Another quote, "Short-term rates influence long-term rates more than the reader might expect. It is not difficult to find sufficient explanation for this observed fact," unquote. Another quote, "There is no reason to doubt the ability of a central bank to make its short-term rate of interest effective in the market." Besides, in the treatise, in the general theory, he also has a lot to say about the power of the central bank as well as its limits. Again, to quote from the general theory, quote, "The short-term interest rate is easily controlled by the monetary authority, but the long-term rate may be more recalcitrant," unquote. Another quote, "If the monetary authorities were prepared to deal both ways on the specified terms in debt of all maturities and in debts of varying degrees of risk, the relationship with the complex rate of interest and the quantities of money would be direct," unquote. Another quote, quote, "A complex offer by the central bank to buy and sell at stated prices gilt-edged bonds of all maturities in place of the single bank rate for short-term bills is the most important practical improvement that can be made in the technique of monetary management," unquote. So that actually quite nicely ties into what Alex pointed out in his paper earlier, that Keynes recognizes that the focal point is generally the short-term interest rate or the policy rate, and that has an influence. But he also knows that long-term interest rates can have an effect on short-term interest rates, or that the central bank can also control the long-term interest rate if it's willing to buy and sell at what he calls stated price of gilt-edged bonds. And if you look at the empirical literature, there is or the facts rather, not just the literature, that there is a tight connection between not only the levels of long-term rates and short-term rates, but also the changes in short-term rates as well as the changes of long-term rates. There's a number of literature that empirical literature by myself and my co-authors, as well as a number of other people, Chakravarti, Delidi, Levero, and others on that. And so suggesting that the literature or in the quantitative finance, there is also a vast literature, but none of that actually draws any insights from the Keynesian literature or the empirical literature in empirical literature demonstrating Keynes's point. I mean, starting from Merton to Heston, Ho and Lee, Hull and White, there is a lot of quantitative models in finance. So what I do in this paper is to modify a number of models. I don't have I can't show the slides, so I'm not going to be able to display those, and it's kind of hard to describe those models verbally, and these are just small modifications. The paper is available in the AEA website, so you can have a look, and the paper is also, the working paper is available at the Levy Institute's website. Let me just talk about the implications. The clear implications are the simple modification of standard interest rate models can incorporate Keynesian approach about interest rate dynamics. This can be quite valuable for understanding and assessing central banks' policy actions and monetary transmission mechanism. These models emphasize the role of short-term interest rate as a primary driver of Treasury yield curve and its shape. Other aspects of monetary policy, such as calendar-based or information, conditional forward guidance, policy pronouncements, large-scale asset purchase, yield curve control would be, at least if this part of Keynes is taken, it would be viewed as secondary. The influence of fiscal deficit ratio or fiscal debt ratio on government bond deals with countries with monetary sovereignty is likely to pale in comparison with the influence of short-term interest rates and central banks' other tools. So there is ample scope for activist policy. At least that's what the empirical study seems to confirm, without the fear of bond market vigilantes. Let me end there. I'm sorry I couldn't share the screen, but hopefully I've been able to represent my paper verbally. Thank you.
Okay, thank you. Yeah, sorry you couldn't get it up onto the screen. But as you said, people can go to the Levy website and read your paper. So we have saved some time now. Let's move on to Lilian. Hopefully, if you have a PowerPoint, you'll be able to share it. Yes, thank you.
Thank you. My paper is on could transaction-based financial benchmarks be susceptible to collusive behavior? So basically the background to this stems from the fact that the LIBOR publication is not guaranteed as of end of December 31st, 2021. We noticed that 24 out of 35 LIBOR rates ceased to be published. And this stems from the fact that there was a LIBOR manipulation scandal in 2012 and the structural changes in underlying markets following the 2007-2008 global financial crisis. So following this manipulation scandal in 2014, the Federal Reserve Board and the New York Fed convened the Alternative Rates, Reference Rates Committee. And this committee was tasked to come up with a more robust reference rates, and in this case, transaction-based benchmarks. So these efforts were escalated in 2017 when the UK Financial Conduct Authority announced the cessation of the LIBOR. So to this effect, the secured overnight financing rate, or the SOFR, will be replacing the US dollar LIBOR, and similar efforts are underway in other jurisdictions. So why are these financial markets benchmarks important? They provide a standardized way of pricing financial products, thereby lowering transaction costs and promoting liquidity. They also allow us to measure investment performance and funding costs. They facilitate risk management through the pricing of loans, derivatives, and mortgages. And from a policy perspective, reference rates allow us to monitor the feedback of the interest rate channel of the monetary transmission mechanism. So prior the 2012 LIBOR manipulation scandal and the 2007-2008 global financial crisis, financial market benchmarks were perceived as an objective representation of underlying money markets. And therefore, the manipulation of the LIBOR and similar benchmarks was unthinkable. So the calculation methodology provided a window for this panel of banks to actually manipulate the LIBOR rates. So how is it calculated? So previously, the LIBOR rates were calculated by getting information or rates from a panel of banks. So banks submitted rates that they perceived to represent competitive market conditions. And these were submitted to a calculation agent who would trim the average by removing the outliers. And this rate was made available by information systems such as Bloomberg and Reuters. So this calculation window, the fact that banks were offering rates that they perceived to be representative and not actual rates, provided a window of for banks to actually lie about the LIBOR, and evidence was unearthed which revealed that actually these banks submitted rates in order to benefit from their large derivative positions and to signal their credit worthiness. So this led to banks being penalized millions of dollars for manipulation of interest rate benchmarks and unlawful collusion. So to curb this kind of behavior, financial market regulators have recommended a paradigm shift, and the paradigm shift entails that we move from estimation-based financial market benchmarks to transaction-based financial market benchmarks. And in this case, instead of banks submitting rates that they perceive to reflect underlying conditions, they should submit rates that are actual rates that are actual rates from underlying money markets. So this paradigm shift is based on the mainstream economic view that prices actually reflect competitive underlying conditions. Definitely, I can say. However, according to the father of economics, Adam Smith, I quote, people of the same trade seldom meet together, even for merriment and diversion, but the conversation ends in a conspiracy against the public or in some controversy to raise prices. So this view actually supports this evidence of the LIBOR manipulation scandal, where banks actually colluded to influence these prices. So the manipulation was actually achieved internally and externally through communication. So internally, derivatives traders asked submitters of money markets information to submit rates that favored their bank positions. And externally, this happened between banks. Banks were communicating with other banks or brokers so that they could get favors in terms of them submitting rates that favored their positions and creditworthiness. So that's an example of how it actually happened. This is from the final notice 2012. Here we have a derivatives trader who was asking a submitter of money market information to submit a rate lower than what it should actually have been. And while this evidence relates to estimation-based benchmarks, the unique features of money markets actually makes the actual rates in these money markets susceptible to manipulation. So firstly, money markets are decentralized, trades are agreed bilaterally over the counter, the trades are negotiated, and this is in line with what Keynes says, where he says that due to uncertainty, decisions are not based on strict mathematical calculations. Secondly, these markets are governed by informal rules. They're governed by conventions, which have been passed from generation to generation. And money markets in particular benefit from the spillover regulation from foreign exchange markets. And one such convention is the ACI Code of Conduct, which promotes the use of trust and reciprocity as banks are trading. Thirdly, money markets are opaque. Bilateral data is confidential and not available to the public. When it's available, it's often published with a lag. So these unique features lead us to a testable hypothesis that transaction-based benchmarks or actual rates are actually susceptible to manipulation and or collusion. Problematically, we don't have actual data available, as I've already explained, but fortunately, we have data from Bank of Zambia that allows us to test empirically the susceptibility of money markets to collusion and or manipulation, and to contribute to the theoretical understanding of money markets. So to test that, we use a common mathematical screening methodology called Benford's Law. And this was recommended by a recent paper by Smith, where he tested the susceptibility of LIBOR rates to manipulation. So this law has been used in a number of fields, including statistics and stock exchanges. So it generally just gives us the distribution of what the actual data should be if the market is meeting competitive conditions, and it compares that data to the actual distribution. Any deviations indicates that there are competition problems in the market. So the results there show us that the individual bank distributions, these are like the actual data. So this is the individual bank distributions are not in line with or in compliance with Benford's Law when we look at the second digit, and these are for the positive interest rate deviations from the policy rate. And when we look at the third digit of the positive interest rate deviations, the picture is the same. Individual bank empirical distributions are not in line with Benford's Law. Even when we look at the negative interest rate deviations, the picture is the same. So this is the second digit. You can see there that the distributions are not in compliance. This is the same when you look at the third digit. So in conclusion, we can see that the empirical distributions do not comply with Benford's Law. And these deviations could be due to potential manipulation and or collusion. So in terms of the implications, we can see that contrary to the mainstream economic view, transaction-based benchmarks or actual rates are susceptible to collusion and or manipulation. And the unique features of money markets make these actual rates susceptible to collusion and or manipulation. So in terms of what's happening out there to curb collusion, the international paradigm shift has been pointing towards transaction-based benchmarks. So while this is good, it's a good move to move from code-based to actual rates. But the results show that regulators and central banks should remain vigilant of potential collusion and or manipulation in these markets. Thank you.
Okay, caught me off guard. That was quick. So we've saved some more time, and we should have plenty of time for questions and answers at the end. Audience, please send me your questions. Mimoza,
Yes.
are you sharing?
Can you all see my screen now?
Yes.
Perfect. Okay. Thank you very much. Now I'll be presenting a paper titled Banks During the Pandemic, a Japanese Perspective. So we all know that COVID-19 has been a health crisis associated with an economic, has had economic consequences across the globe in all countries all around the world. Now, given the lockdown measures, the government has had to offer their financial support to both the household and corporate sectors. Japan has been no exception. Their initial economic response was the allocation of 117 trillion yen. They also provided 100,000 yen to every resident in the country. This is just to name the few of these economic measures, the economic support that the Japanese government has implemented to stimulate the economy. Now, I'm looking at the bank's role during this health and economic crisis. Banks have been at the heart of it in the good sense. Contrary to the 2007-2009 financial crisis, where they were the center for all the bad reasons, they have been assisting the government this time around to deploy this economic support. What the implication of it has been, given the uncertainty that's associated with COVID-19, and these unconventional measures that have been implemented by the Japanese government to counter the adverse effects of the pandemic have increased, I find, the cash hoarding of the economy. And that's both for the household sector and the corporate sector. So Japanese banks have seen a surge in deposits held by both sectors, and as well as a decline in the demand for credit, for loans. Now, Japanese banking sector has faced low profitability and with ongoing razor-thin margins and prolonged low interest rates at home, Japanese banks have continued their overseas activities in a search for yield. And they've been leading in the international lending market since the post-2009, and they continue to at a much higher rate. So we've seen that they've increased their overseas activities furthermore, but in particular, I find that they have increased their exposure to the offshore financial centers, which I will argue that they could have potential domestic financial stability implications. Now, I'll start with the overview of the economy, and I focus, like I've hinted, that it's the period during the COVID-19 and the role of the banks. Now, during 2020, Japanese GDP growth rate fell by 4.5%. It's been argued that the main contributor attributed to this decline has been the decline in private consumption, even though, as I previously said, that every resident in the country has received 100,000 yen, private consumption has not picked up. Cash and deposits of households have increased to nearly over 1,000 trillion yen in the second quarter of 2020, and at the same time, the demand for bank loan has declined. The same we've seen for the non-financial corporate sector, where cash hoarding has increased during the pandemic, and the bank credit has declined. Now, when I talk about the demand for bank credit, the Bank of Japan publishes data on a survey that is a senior loan officer opinion survey on bank lending practices at large Japanese banks. And we've seen this over the years, that the demand it's in percentage points. And we see that during the pandemic, obviously, the dark line here represents the firms, all size firms. They increased the demand for loans at the onset of the pandemic. They need, given the lockdown measures, their business was closed. Therefore, they needed the credit to survive the crisis. But it has declined thereafter. At the same time, during the onset of the pandemic and during the pandemic, the demand for bank loan from the household sector has declined, but recently picked up, and this is mainly due to the demand for housing loans more than anything else. But what we see here is that the demand for bank credit by firms is lower than the pre-pandemic crisis, and this hints that the firms are inclined to invest given the uncertainties surrounding the COVID-19, which is still unfortunately still going. Now, so we've seen a surge in deposits, in cash deposits from both household and corporate sector, and at the same time, a decline in bank lending. So this has led to a cash surplus of the Japanese banking sector, which we've seen in mid-2019 has increased substantially. Now, Japanese banks, now this is calculated, we're saying that the cash surplus it represents the difference between total loans and cash and deposits held by the Japanese domestic banks. Now, as I briefly mentioned, Japanese banks have been the leading banks in lending internationally since the aftermath of the 2007-2009 financial crisis. Now, they've increased, their overseas lending has increased from 4.63 trillion in 2019 to more than $5 trillion in 2020. If we have a snapshot of where do they lend, this data from the BIS location banking statistics shows that outstanding cross-border claims to selected countries. We'll see that the US dominates. So the Japanese banks lend a lot to the US market. They're heavily exposed to the US. They've always been since the early 2000s. The second most exposed country that Japanese banks are to is the Cayman Islands. That's followed by the United Kingdom, France, and then Germany. Now, what this graph shows, not only that there's been an increase in overseas lending over the last few years, but we've also observed that at the onset of the COVID-19, we see a slight decline in the overseas exposure or cross-border claims to the US, for example. And we see a slight decline in the overseas bank lending to the United Kingdom. But the cross-border claims to Cayman Islands, which is an offshore financial center, has kept on steadily increasing. So they kept increasing their lending to Cayman Islands. Now, as I said, they have a large presence in the US. Now, we know that cross-border claims take place mainly via the headquarters of banks in Japan can lend overseas, but they can also lend, it's cross-border claims captures even those lending by setting up a branch, a subsidiary in host countries. So in this case, Japanese banks setting up a branch or subsidiary in the US. Now, data from the US government statistics, the Federal Financial Institution Examination Council publishes data on all banks operating in the US market and their cross-border claims. So I got some data for the three main Japanese banks that are present in the US market. And looking at their cross-border claims of Japanese banks located in the US, as you can, this shows in the graph, cross-border claim consists mainly of claims towards Japan, their home country, and offshore. And in offshore, I've included all the countries, that offshore centers that the IMF classifies as offshore financial centers, including here the UK, the Cayman Islands, Bahamas, and so on. Now, it's interesting because mainly these total claims consist of claims towards Japan and the Cayman Islands. And as I said, these claims include the main three Japanese banks, that's Mizuho, Sumitomo, and Mitsubishi, and they all have they have foreign affiliates in the US market. Now, what does this mean? We know that Japanese banks have increased their asset dollar holdings by 88% in the decade post 2007. This is provided by in the literature. Now, so when we observe that a lot of liquidity it's sent from a Japanese affiliate located in the US to their potentially parent company in Japan, this could be an indication that an internal capital market channel exists. So it's a possibility of a channel of US dollar transmission between the affiliates in the US and home country in Japan, given that they have a high asset dollar holding and been so in the last decade or so. But so it not only could reflect an internal capital market where affiliates from the same parent company send liquidity, but also it can reflect the activities in the interbank market vis-a-vis other banks located in Japan. Okay, so we also know. So that's the exposure or the liquidity sent into to other affiliates located in Japan or their parent company in Japan. But Japanese banks also hold a large proportion. Well, actually, they hold, I think, nearly 20% of the global collateralized loans obligations are held by Japanese banks, and they are risky financial securities. And they are issued by special purpose vehicles. Now, these special purpose vehicles are non-bank financial institutions, which they could that probably set up in these offshore financial centers. And given that the Japanese banks have a large cross-border claims against non-bank financial institutions, such as SPVs, this is an indication that so the large exposure to offshore financial centers indicates that reflects the holding of securities such as CELIOs. And that's an argument provided by Izaura et al. 2020. Now, the role of the financial centers also could reflect that it's not only for tax purposes. A recent paper by Coppola et al., they revealed the intermediary role these offshore financial centers play in the international capital market. So if we have claims of Japanese banks being sent off to Cayman Island, and if Cayman Island is used an intermediary to channel these funds to another country, so Cayman Island will act as a bridge, then this could hinder the true position of banks. So say, for example, the Japanese bank intends to lend to Italy via its established subsidiary located in the Cayman Island, but the official statistics will record this as claims towards Cayman Island. When actual fact, those claims will end up in lending to Italy. So that it's an argument that Coppola provides, and he maps of all of this, and it could also hold for the Japanese banks. Now, if these offshore financial centers truly are not served only just for tax purposes, but also as a hub or as a bridge to invest, purchase, or issue securities, then they can obscure both country risk as well as investment security risk. So when offshore financial centers serve as a bridge, as I already said, to channel funds to other countries by means of purchasing or lending, the direct country risk assessment could be undermined. And of course, the investment, the purchase of various financial products, for example, CLOs, conducted via foreign subsidiaries located in offshore financial may hinder the level of risk banks undertake. Because again, this will be recorded as claims to offshore financial centers rather than capture them. No, so to conclude, the quantitative easing that already was in place and the various stimulus packages provided have resulted in an increase in the cash holding of both the household sector and the corporate sector. So in effect, they've been ineffective to stimulate the economy and to serve the purpose of these unconventional measures. With this, on the other hand, has resulted in the Japanese banking sector being flooded with more cash, the falling demand for credit in the economy, because profitability challenges for the banking sector. As Alexis explained in his presentation, Japan has had this yield curve control in place, which put a strain on the profitability. And now with the aftermath of COVID, the profitability challenges have been exacerbated for banks. So with razor thin margins in the domestic markets and more liquidity available, Japanese banks have further expanded their overseas activities, and in particular their exposure to offshore financial centers, which this may obscure the true risk exposure to markets and products. Furthermore, the activities in offshore financial centers could also hinder the effectiveness of banking regulation, such as the supplemental leverage ratio. And I think I end here.
Okay. Just
Thank
on
you.
time. Thank you. Okay, Jan, you were worried about the time, but we are fine. So, last but not least.
Okay. Thank you. Mimoza, you're going off. Let me see if I can.
I
hold on.
stopped sharing, so you should be fine.
Yeah. I know. I'm just wondering what I've got on my. Let me see if this is the one that I. No, that's the wrong one. Sorry. There's another one which is somewhere here. I'm sorry, I'm getting a little bit confused about this. Let me. I seem to be unable to connect to my I seem. Let me try have one last go. Okay, here we are. That's it. Thank you. My apologies for this. Okay, I'm going to be talking about the yield curve, and specifically yield curve control and the capital market in Japan. Can I say that my basic summary is I'll talk about, I'll introduce this and mention where some of the ideas come from. Then I'll talk about yield curve control in theory. This is the this was the doctrine introduced, or the monetary policy doctrine introduced in September 2016 in Japan. I'll say a few words about yield curve control as it has worked in practice, and then make some remarks by way of conclusion as to how this has all been affected following COVID. Okay, introduction. The background to all of this is really three different studies. One, a book that Alexis and I edited on unconventional monetary policy and financial stability. The case of Japan, this came out this year, and it has, sorry, it came out last year, beginning of last year. It's full of the very, very good information about the kind of unconventional monetary policy that's been pursued in Japan, and it makes the case for why Japanese monetary policy is worth studying. There's a paper that Joe Mitchell and I wrote, an extensive paper on monetary policy in the UK, which used some of the lessons of Japanese monetary policy, and in particular yield curve control, to apply to the UK. In fact, the paper, this particular working paper, argues that we should be using a form of yield curve control, although, as I shall indicate, not necessarily the one that's been pursued in Japan, and I'll make some critical comments on this. And finally, for the sort of central banking aspects of this and the macroeconomics of this, there is a book which is coming out, I believe, in this month from Oxford University Press, Interest and Capital, on the monetary economics of Kalecki, which contains a large amount of the theoretical theory and the macroeconomics behind this particular presentation. Okay, yield curve control in theory. This was, yield curve control was introduced in September 2016 as part of a policy of quantitative and qualitative easing. It took the previous quantitative easing and added to it yield curve control, and thereby called it quantitative and qualitative easing, QQE, for the in-crowd around the Bank of Japan. And the idea was to reinforce the monetary stimulus, which did not seem to be working very, very well by 2016. There was an interesting justification for this put forward by the Bank of Japan. The argument went as follows: that if you control the yield curve, if you try to control the yield curve in normal times, then this is a form of financial repression, and of course repugnant to all right-thinking mainstream economists. However, in crisis, the crisis was defined by a situation where the monetary transmission mechanism appears to have broken down, then yield curve control could be useful, helpful, and appeal. This was justified by an appeal to Keynes's views on long-term interest rates, in particular Keynes's views on the funding of investment, this idea that even if companies borrow in the short term, borrow short term to finance investment. Ultimately, their main purpose is to issue bonds or stocks of some kind to repay the borrowing, and those and because of this, the interest rate on the stocks or bonds, in other words, the long-term interest rates, are more important than short-term interest rates. And this was it was further admitted that the monetary transmission mechanism, perhaps with the exception of the exchange rate channel, really works through long-term rates of interest through, as I said, through this funding of investment and the wealth effect, and a wealth effect which is supposed to affect consumption in response to changes in short-term, in interest rates. The purpose of having low long-term interest rates was really to reduce the costs of government borrowing. If the government is engaging in fiscal stimulus and borrowing hugely, if you have low long-term interest rates, then obviously this reduces the cost of government borrowing. And again, there is this idea that there is that the true effect of long-term interest rates is through arbitrage between credit and real investment. Keynes famously argued for the euthanasia of the rentier, in other words, pushing down interest rates so low that businesses, would be able to finance their investments virtually or with very little interest cost. And incidentally, much the same argument can be found in Marx. Marx's idea being that if interest rates were reduced down to zero or very, very low level, then the only way in which capitalists could make money would be through real investment, and they would that's what they would do with their money rather than just leaving it in a bank or leaving it in financial assets. A yield curve control in practice actually brought down government bond interest rates, and this you can see in the figures that Alexis put forward. Definitely from 2016, there was a major reduction. I'll show you in a moment. But there's been questionable evidence that somehow it could force investment, let alone consumption, albeit the evidence on consumption is, of course, not clear or confused by the fact that we've also had more recently COVID reduced possibilities of of consumption, and quite what's the effect of COVID and what's the effect of what's the ineffectiveness of low interest rates is difficult to see. If you look at the situation in 2016, QQE was announced in April 2013, at which point all interest rates were positive. All yields on all government bonds were positive. They in the eventual in 2016, it was announced that negative interest rates would hold from up to the 10-year bond, up to the 10-year rate. And sure enough, this pushed the yield curve down, and it's it more or less has stayed there since, albeit by the summer of 2016, it was all the rates virtually up to the 20-year rate were negative. If you look at the most recent yield curve, you can see that actually there's been a tendency for longer term rates to come back up again, but still staying very, very low. The 40-year rate at around 0.75%, and the short-term rate going positive after 8 years. What effect did this have on fixed capital formation? Fixed capital formation crucial here because it's fixed capital formation, which is really the dynamic element in total expenditure, that and fiscal policy. But you find that in the US, in Japan, gross domestic fixed capital formation peaked in the fourth quarter of 1996 at 42.5 trillion yen, where after which it fell off down to a low point of 28.2 trillion in the fourth quarter of 2009. And then it recovered up to into 2017, in the first quarter of 2017. So after the yield curve control policy was announced, it was at 34.2 trillion, and the recent peak was 36.5 trillion. This was in the third quarter of 2019, so effectively relatively little effect on gross domestic fixed capital formation. After that, it seems to it was falling off. Even before COVID started. Now this is totally, yeah.
Can you conclude?
Yeah, I'm going to finish off. It's the stock market effect was the stock market was really somewhat subdued by January 2020. It was the same level as 2016. So interestingly enough, not much affected by a yield curve control, but with the renewed QE after COVID and the liquidity of the household sector, bond buying has been boosted up to around the Nikkei going up to 28,000, so massive increase. There's a simplistic conclusion from all this that monetary stimulus does not overcome economic stagnation. It's and that QE and central bank bond buying generally merely raises stock prices. I want to argue that actually something more complex is going on. The simplistic version that QE doesn't overcome economic stagnation, it merely creates a bubble in the capital market, increasing wealth inequalities, is the simple version. What's more critical is the impact of yield curve control. What happened was that the QE has been effective in stabilizing the capital market through the provision of liquidity, effectively the socialization of the capital market, but financial effects are much more complex than just stimulating the stock market. What the yield, if you take the yield curve as showing the rate of exchange of one type of financing for another type of financing, you've got interest rate changes and yield curve stimulate changes in financing and the different types of financing, as opposed to real economic activity or even prices of goods or services. This is a fundamental argument that changes in interest rates change the type of financing. They don't change things in the real economy. And what's happened is, as Mimoza has pointed out, is that the corporate's response to QE was to acquire more remunerative assets abroad, takeovers in the US, which have been hedged by foreign liabilities. This is the important role of dollar swaps, which we haven't had time to discuss in this session. And this is the key punchline. What yield curve control has done, what the kind of yield curve control has been implemented in Japan has done, is it's made the Japanese capital market unattractive to foreign portfolio investors. Yes, the Japanese capital market is very liquid, but at prices which are unattractive to foreign portfolio investors. So you've got a kind of flooding of global financial, with COVID, there's been a flooding of global financial markets with government and corporate debt, a kind of Japanization of the US and Western Europe, allowing a more complex internationalization of Japanese corporates with the dollar swap backstop, and the yield curve control discouraging foreign interest in the domestic capital market. And I would conclude by saying this is a stable system, but vulnerable to government austerity and a social problem of stagnant social structures. But I don't have time to explain. I'll leave this there, and I look forward to an interesting discussion on all these very, very good papers. Thank you.
Okay, thanks. So I didn't get very many questions from the audience. I did jot down some questions, a question on each paper. So what I'm going to do is just quickly go through questions, and then I will give each of the presenters a chance to respond to any of those that are relevant or interesting to them. So on the first paper on the consolidation, so there was a mention of the possible problem of too big to fail. Are there other reasons to worry about consolidation, about reducing the number of banks? And Avi had a question, how does the SRM affect the ability of the EU to manage crises in general? So that's the first paper. Second, what are the implications? A couple of people have mentioned the unconventional monetary policy. What are the implications of going off, and what are the lessons that we've learned from using unconventional monetary policy? Tanweer had a very specific question. He wanted to know whether you were looking at connections at connected at levels or changes of the yields. The third paper, and also this was mentioned in other papers, why not just have the central bank directly set the long-term rates on treasury bonds? Fourth paper, oh yeah, why not just use the domestic central bank's target as the reference interest rate? That would help to support domestic monetary policy. Why allow your domestic banks and your credit card companies and so on to use a rate that is not under the control of the domestic central bank? Fifth paper, and this also applies to the last paper. It seems like the obvious solution in Japan is direct government spending, rather than trying to encourage the private sector to spend when consumers prefer to accumulate savings, and it seems that firms don't really want to invest. So why not just use government spending? I'm also a little curious as to whether some of this offshoring, it's sort of related to the tax issue. How is this related to financing the consumer loans of our billionaires, as the ProPublica report has shown? And lastly, there was a question, but I think Jan did get to it. What's the relationship between low rates and stock market price bubbles? So let me go to the first two presenters, and I'll give each of you 3 minutes. I hope this is going to work. No more than 3 minutes. The first paper had 2 presenters. I want to give each of you some time. So go ahead.
Izaura, if you want to start, I'll complement whatever you say.
Sure. So regarding the question from Avi, the single resolution mechanism and the governing through financial market reinforces the channels on how finance constrains state sovereignty, particularly during crisis, and deprives them of a de facto power that they need to shape those crisis policies. This was also put forward by Wolfgang Strick years back when talking about the European consolidation state. For instance, in the event of a crisis, the SRM will increase financial pressure over national states and banking systems due to a threat of bail-in, and this pressure increases with the possibility of the use of national deposit schemes. Mariana, do you want to? And also to Wray. besides too big to fail, and Mariana can complement here too with the very several examples. Besides that, the eliminating smaller and medium banks and the policies that push or create incentives for that affect particularly the southern periphery, and they disrupt the national economies of these European members such as Italy, Greece, Portugal, Spain, that were already very much damaged by the sovereign debt crisis, and it models or shapes the remaining large banks into riskier business models that comply to the regulatory standards, and the overall market-based business models increase.
It's pretty much the answer has been given, but I just think there is a paradox in this resolution framework at the European level, is that the functioning of this framework is creating banks that are too big to be resolved. So in the end, the framework doesn't solve any problem, because it can only be applied to small banks and national banks, and that's what's happening. And it's happening because the ECB has this view that the European integration needs to go through a consolidation process of European banks. So they want larger and fewer banks that exist now. So this framework is in fact eliminating small banks and concentrating capital in larger banks. For example, Banco Popular in Spain was resolved and sold for €1 to Banco Santander. Banif was resolved in Portugal. It was a small regional bank, and it was also sold to Banco Santander. Through this process, we are creating European banks that are too large to be resolved, because no one believes that you could apply such strict bail-in rules to a bank such as Santander or Deutsche Bank. When the time comes, we don't have the mechanisms to liquidate or resolve these large banks. So the rules will allow the exception of the systemic crisis to use different kinds of instruments to intervene in these larger banks. So this is the problem of the solution to a crisis. We don't think that this framework will work in the event of a systemic or a large crisis. It won't work in the event of failure of a large bank in Europe. It only serves this consolidation process of small and regional banks at the European level. The consequences, as Randall Wray has asked, the consequences of this consolidation, well, there are several consequences. The too big to fail is the largest one, but there are also consequences for small countries due to this consolidation. First, because there is a detachment between national interests and the banking system, because these rules are eliminating state-owned banks that are impossible to maintain under these rules, and they are also eliminating nationally based banks, therefore completely disconnecting national interests and economic interests from the banking system. And also, there is a problem of sovereignty and democracy. We've seen this in Italy, in Spain, in Portugal. For example, when the Single Resolution Board decides that the bank should not be resolved and must be liquidated, it does so saying that there is no public interest in maintaining those banks. Well, Italian governments and Portuguese government and Spanish governments have a different opinion concerning the public interest of those banks. And so the framework is designed to prevent governments from taking their democratic decisions, transferring those powers to technocratic institutions. They are much more concerned with market outcomes. So these are some of the criticism and the reflections we've made so far.
Okay, thanks. Alexis?
Here we go. Hi. Yes, Tanweer is it yields or is it changes in yield? We're talking about changes in yield. So specifically, it's the forecast error variance. So yeah, it's the changes in yields we are looking at. Now, regarding, I think there was a couple of other questions that were linked to my presentation about QE. Just to sort of long story short, what we are arguing here is really that the basic inflation targeting that was then sort of followed by forward guidance and then QE and then QQE, that yield curve control is almost like the logical next step of that. So the next thing that will happen is, you can just look at Japan, will be yield curve control. It's not about rolling back, sort of saying, let's end QE and go back to how things were in the early 2000s. I actually read, during the Christmas break, I read Mark Fisher's Capitalist Realism, and sort of, it was a reminder that quite often we are sort of more, we find it very difficult to imagine something completely different, that we always sort of thinking, yeah, what if we go back to how things were instead? I don't think we will go back. I think we have to get used to thinking that maybe yield curve control is completely standard, and that's sort of where what the paper is saying, that it's not as dramatic as we think. And the only thing that people do, or market participants do, is to start to look at, okay, so what's the next step? Okay, big shock, yield curve control. It's odd that the state determines the long-term interest rate, but as we can see, it's possible. It's not as dramatic, and it's not about saying, okay, this is a crisis situation that will last for 1 or 2 years. Japan has had it now for 5 years. When Australia introduced it in March 2020, they said that this is really only a temporary measure. Maybe, who knows, maybe for a couple of weeks or a couple of months. And it's been in place for almost 2 years. So that is the logic here, is that it's not about rolling it back, scaling it back. It's about what is the next step.
Okay, thanks. Tanweer.
Right. Several things. First of all, I actually wasn't able to use my presentation. So one of the things that I should have pointed out is that everything that I say are my views and not that of any institution. So just wanted to put that on record. So let me try to address the question. There was a question about why or why not target long-term interest rates. So clearly, I think both the evidence and the theory, as Alex and my colleagues Alex and Ian has pointed out, the central bank's targeting of long-term interests is definitely possible, feasible, and it has happened in the past. It is happening now. So it's really a matter of, definitely it's feasible. Whether it's desirable or not, that's a matter of, of views and as well as economic consequences. And one looks at, looks at the facts and decide what it's possible and who it benefits and who it does not benefits. Obviously, those who benefit from having volatility of interest rates or trading in the volatility would not want to have that. Again, whether you want to target any specific interest rate for what period, what time, again, it's a matter of not just of technical feasibility, but also political, social, and convention and agreements on that. And in a society like the US, a democratic society, it would probably need the kind of backing of the Congress or of political authorities or the regime in charge. Also, I would point out that having interest rate control on one area or the other does not necessarily mean it's across all areas, even if the authorities target the rates on or yield curve control on government securities, that there will still be volatility and trading in spreads, etc. So again, I think it's a matter of what you want, whether you want to have, you could target exchange rate, for instance, that was done, but obviously that also has its own set of problems. The conventional view in the mainstream economics is still, although that's changing, is that this, I think Ian had talked about, is that yield curve control necessarily is financial repression, and financial repression necessarily is bad or welfare reducing. I think that can be debated, and that should be debated, and we look at the balance of evidence and the arguments, theoretical arguments, to examine that. That's my view. Thanks.
Okay, thanks. Lilian. Oh, Lilian, turn on your mic.
Sorry about that. Thank you very much for this question. So generally, the reference rates in financial markets, normally the banks or financial market institutions, they want to reference a rate that captures the term risk as well as the credit element. So if we use the central bank policy rate, which normally is overnight, it's a risk-free rate that doesn't capture those risk elements. So for example, in Zambia, because we don't have other reference rates, our market is not that developed as the other markets, we don't have the reference rates. So the challenge that you see is that we have no choice, but we've prescribed to the market that they should use the policy rate. But market practitioners complain that that rate does not have the credit and the term risk elements. So you find that different banks have different margins that they add to the policy rate, and it's not standardized. So that's the reason why I think even the international paradigm shift is still insisting that we have a transaction-based rate, but that still captures the credit and the tenor, the term element. So thank you.
Okay, thanks. Mimoza.
Yes, hi. Okay, so the offshore question in terms of the billionaire consumer loans and the research, I have no doubt that banks do play a major role in assisting the billionaires in tax evasion, let's say. But my main concern on the concern that I was trying to express in the presentation and the data and their activities of Japanese perspective is that perhaps these offshore activities, I won't say the words replace, but imitate like the role of the shadow banking system, whereby they channel funds via the offshore and to hinder their true positions, their true activities, and their true positions basically in the global markets. So that's what I was trying to hint. I'm not sure if I got your point of view correct or not, but in terms of the question for the why not, seeing that the quantitative easing and the role of banks in providing the liquidity, the credit to the economy has been ineffective, and why not replace it with direct government spending? That was a joint question with Jan. Should I let Jan answer that?
No, you go ahead. We're okay on time. He will get his time. Don't worry.
Okay. Well, I'm not sure on how beneficial that would be in terms of replacing this credit directly to the economy, and thereby excluding the role of banks in the economy. I'm not sure about that.
Okay. All right, Jan.
Yes, can I, on that question, I think the giving money directly to households, it presupposes that households will go out and spend. It overlooks the possibility, the very real possibility, that people actually use this money as a way of debt management.
Hey, John, I actually had in mind direct government spending,
Yeah,
not
and
checks to households.
yeah. No, I think that in this respect, direct government spending is much better, except that you also have to consider what type of direct government spending. You know, in the case you find governments then under pressure from commercial lobbies to build infrastructure works. Japan famously has built, infrastructure works which are largely unnecessary, but has skimped on provision of social care and social facilities. These have to be paid for by householders themselves. So, there is yes to direct government spending, but it needs to be direct government spending that's useful rather than just spending. On Mariana's question, I actually think I was rather negative about QE. QE has one important consequence, economic consequence, and that is that it's excellent at stabilizing financial markets. If you look at what happened in after the 2008 crisis, the buying of assets by central banks and treasuries was stabilized the financial system very, very nicely. And since then, because they've continued this, it's stabilized it. If you combine this with QE, then the implication is a permanent system of central bank open market operations to keep financial markets stable. Financial stability is easily assured in this way. What was wrong previously was that under the new consensus based around interest rate management, central banks had effectively abandoned by the end of towards the end of the 1990s, they'd abandoned these kinds of open market operations, and their return is very good, but it still doesn't deal with all the key issues of political economy, which are issues of employment and so on. In this respect, I don't think that central banks can do very much other than supporting government finance.
Okay, thanks. I hear the piano music.
So, my daughter.
I think that means we're coming to the end. Okay, thanks to all the participants and the organizer. I don't know who the organizer was. And
Alexis.
to our tech person and the audience. I think we have another panel to run to that starts in 15 minutes. So goodbye for now.
Thank you,